Hello, financial enthusiasts. Welcome back to where we break down market trends, dissect financial data, and uncover insights that can shape your investment strategy. Today, we're setting our sights on the Nifty 50 and its performance over the last 15 years. For those unfamiliar, the Nifty 50 is a benchmark index for the National Stock Exchange of India, comprising the 50 largest and most liquid Indian companies. Now, to truly understand the Nifty 50's performance, we need to discuss the compound annual growth rate, or CAGR. This handy little metric smoothens out the volatility in annual returns, offering a more comprehensive view of average annual growth over a given period. It's an essential tool for investors, providing a consistent growth rate for an investment. So, grab your calculators, sharpen your pencils, and let's jump into the numbers. All right, first things first. Let's take a look at the overall returns of the Nifty 50 index over the past 15 years. This index, as many of you know, is a barometer of the Indian economy, representing the top 50 companies across 14 sectors. It provides a snapshot of the market's health, reflecting the ebb and flow of economic conditions. As we embark on this journey, we'll witness a panorama of market movements, from the highs to the lows, and everything in between. Let's rewind to 15 years ago and start our expedition. In the first few years, we see a roller coaster ride of ups and downs, reflecting the global financial crisis. The market took a nosedive, but like a phoenix rising from the ashes, it rebounded, demonstrating the resilience of the Indian economy. Moving forward, we see periods of steady growth, punctuated by occasional market corrections. These fluctuations epitomize the inherent volatility of stock markets. Yet, through it all, a discerning eye can spot the overarching upward trend, a testament to the long-term growth potential of the Nifty 50. As we approach more recent years, we encounter a significant dip, a reflection of the global pandemic's impact. Yet once again, the market demonstrated its resilience, recovering rapidly and even reaching new heights. These highs and lows, the peaks and valleys, are not just numbers or data points. They are narratives of economic conditions, policy changes, global events, and investor sentiment. They are the pulse of the market, the heartbeat of the economy. So as we navigate this journey, it's essential to remember that while the market's trajectory may be filled with twists and turns, over the long term, it has an inherent tendency to trend upwards. It's this long-term perspective that can turn market volatility from a cause for concern into an opportunity for strategic investment. Buckle up, it's going to be an enlightening journey through the market movements. Remember, investing is not just about riding the waves, but also understanding the tides. By understanding the past, we can better navigate the future. So let's dive deeper and continue to decode the Nifty returns. Now, let's delve into the compound annual growth rate, or CAGR. The CAGR is a critical metric that investors often use to measure the mean annual growth rate of an investment over a specified period. It's a bit like an average, but instead of simply adding up returns and dividing by the number of years, it accounts for the compounding effect. This essentially means that it takes into consideration that the investment grows each year, and the next year's growth is built on the previous year's growth. So, why is it important? The CAGR smoothens out the volatility in the annual returns, providing us with a comprehensive view of the average annual growth over the time period we're looking at. It gives us a clear single number that represents the consistent annualized return. This is hugely beneficial for investors as it allows them to compare the performance of different investments or to assess how their portfolio is performing against a benchmark index like the Nifty 50. Now let's take a look at the CAGR of the Nifty 50 over the last 15 years. To calculate this, we need to take the final value of the Nifty 50 index, divide it by the initial value, then raise the result to the power of 1 divided by the number of years, in this case, 15. After doing this, we subtract 1 from the result to get the CAGR. So, what does our calculation tell us? If we start from 15 years ago and fast forward to today, the CAGR gives us a picture of how the Nifty 50 has grown on an annual basis. It's like a time machine, giving us a snapshot of the average yearly growth rate. Now, it's important to remember that while the CAGR gives us a great overview, it's not the be-all and end-all. It's a tool, and like all tools, it has its limitations. For instance, it assumes a smooth ride from the start to the end point, which we know is not the case in the volatile world of stocks. There are ups and downs, and the CAGR doesn't capture the journey, only the destination. However, understanding the CAGR is essential for investors as it gives insights into the compounded annual growth of their investments, helping them set realistic expectations for their portfolios. It's a compass that points towards the average direction of growth. But remember, the CAGR is just one piece of the puzzle. There are many other factors to consider when making investment decisions. So, as we wrap up our discussion on the CAGR, let's remember that it's a powerful tool in our investment toolkit. It provides a simplified view of growth over time, helping to set expectations and compare performance. But as with all tools, it needs to be used wisely and in conjunction with other metrics to form a complete picture of an investment's performance. So, what can we take away from this 15-year Nifty journey? The Nifty 50 index has shown us that the market is a roller coaster ride of ups and downs. It's taught us that while there may be years of slow growth or even negative returns, there are also years of robust growth and high returns. The key is consistency and patience. Over the past 15 years, there have been several notable market events that have impacted the Nifty 50. The financial crisis of 2008, for instance, was a major blow to the market, causing a sharp decline in returns. Yet the market bounced back and we saw a strong recovery in the subsequent years. This goes to show that while the market can be unpredictable and volatile, it also has the potential to recover and thrive. Another key takeaway is the importance of long-term investing. The 15-year CAGR analysis reveals that despite the short-term fluctuations, the Nifty 50 has provided a decent return over the long run. This emphasizes the power of compounding and the benefits of staying invested for the long term. Now, how does this information impact your investment strategies? Well, understanding the historical performance of the Nifty 50 can help you set realistic expectations for your investments. It can guide your decision-making process, helping you determine when to invest, how much to invest, and what kind of returns to expect. Furthermore, this analysis can help you diversify your portfolio. By understanding the performance of different sectors within the Nifty 50, you can make informed decisions about which sectors to invest in and which to avoid. This can help reduce risk and increase potential returns. Lastly, this journey through the Nifty 50's past 15 years underscores the importance of staying informed and keeping track of market trends. By staying updated on market movements, economic developments, and financial news, you can make proactive investment decisions and adapt your strategy as needed. In conclusion, the Nifty 50's 15-year journey is a testament to the dynamic nature of the market. It's a reminder that while the market can be volatile and unpredictable, it also holds immense potential for growth and returns. By understanding the trends, recognizing the key market events, and leveraging this information, you can navigate the financial market with greater confidence and poise. Remember, investing is not just about making quick profits. It's about building wealth over time. It's about understanding the market, making informed decisions, and staying committed to your investment journey. The Nifty 50's 15-year performance is a powerful demonstration of this principle. Understanding the historical performance of the Nifty 50 can provide valuable insights for your financial journey. It's a roadmap that can guide your investment decisions, helping you navigate the market with greater confidence and success. So, keep learning, stay informed, and let the power of compounding work its magic. Happy investing! As we conclude today's video on Nifty returns and 15-year CAGR analysis, I encourage you to share your thoughts and observations in the comments below. It's through these discussions that we deepen our understanding and broaden our perspectives. This journey has been about more than just numbers. It's about understanding the trends, the fluctuations, and the power of compounded growth. It's about seeing the bigger picture, not just for the Nifty 50, but for the world of investing as a whole. Don't forget to engage with us. Give this video a thumbs up if you found it enlightening. Hit the subscribe button to stay in the loop with our content, and ring the bell icon to get notified every time we release a new video. Your engagement fuels our efforts to bring you more insightful content. This is from signing off. Happy investing, and may your portfolios thrive in the dynamic world of finance.